All right, welcome to Talk Tickers. Today we're diving into a real head-scratcher, Williams-Sonoma's latest earnings report. Now on the surface, the company knocked it out of the park. But the stock? It went the other way. So let's break down this disconnect and figure out what Wall Street was really seeing. So check this out. It's really a tale of two tapes. On one side, you have the results, and they look great. I mean, they beat earnings estimates, they beat on revenue, and maybe most importantly, their comparable sales were up a really strong 4%. Fantastic, right? Well, then you look at the reaction. The stock dropped over 3%, and we saw a spike in put options. Basically, a lot of people betting the stock would fall further. So what gives?
Okay, to understand what's happening, you have to start with the story management was telling on the earnings call. And believe me, they were painting a very rosy picture. It was all about resilience, operational excellence, and some big strategic wins.
And the numbers really back them up. I mean, the quality here is what stands out. This wasn't some flimsy beat. It was strong across the board. Revenue was up almost 5% from last year. And that 4% comp growth, that is a huge acceleration from a decline last year. And we're talking about all of their brands turning positive. And get this, they did all of that while actually expanding their operating margin to a very healthy 17%. That's tough to do.
So how are they pulling that off? Well, a huge piece of the puzzle is their big push into AI. Management was really excited to talk about Olive, their new AI shopping assistant. Think about this. It's already resolving over 60% of customer chats without a human ever getting involved. And the impact is real. Customer service handle times have been slashed from 23 minutes all the way down to just 5. That is a massive, tangible cost saving that goes straight to the bottom line.
And look, management knows there are storm clouds on the horizon. They're not just sitting around waiting for headwinds to hit. They laid out this whole 6-point playbook for how they're going to protect their margins. It covers everything from negotiating with vendors to moving production around and even some careful price increases. The message they wanted to send to investors was crystal clear. We are in control.
And if you want proof of their confidence, this is it. Despite all the talk about tariffs and external pressures, they actually raised their guidance for the full year's profitability. So let's recap. We've got a strong quarter, real savings from AI, a clear plan to handle problems, and raised guidance. So I have to ask again, why did the stock fall?
Well, that brings us to the other side of the story, the bear case. Because for all the great things that happened in Q3, the market is always looking forward. It was listening for clues about the future. And that, my friends, is where the fear crept in.
This question from an analyst on the call just perfectly captures the anxiety in the market. See, it wasn't about the quarter that just happened. It was all about what's coming next. Specifically, when are those tariff headwinds really going to start biting?
And then the CFO confirmed their worst fears. He said point blank that tariffs will have a larger impact on margins in Q4. He basically explained that they got a little lucky in Q3, pulling inventory forward and whatnot, but that the full force of the hit was still to come. The market heard that as a clear and direct warning. Margin pressure is coming.
And you have to remember, this warning didn't happen in a vacuum. Investors are already nervous about weak housing turnover, which of course hurts sales of big-ticket items like furniture. Plus, Williams-Sonoma is facing much tougher comparisons in Q4 versus last year. All of this is happening in a really volatile tariff environment, with potential rates up to 50% on goods from key partners like India. It's a lot of uncertainty.
You can see this anxiety baked into the stock price even before the report. Over the last 3 months, while the broader consumer sector rallied more than 10%, Williams-Sonoma stock fell 12%. That huge divergence tells you the market was already pricing in these company-specific risks.
So we have a best-in-class company posting great numbers, but it's staring down a wall of worry about the future. That sets the stage perfectly for our final segment, the next call, and our thesis on the stock.
It really is a tug of war. On one side, the bulls are pulling hard, pointing to those compounding savings from AI, the incredible strength of their brands, and smart moves like repositioning their stores. But the bears are pulling back just as hard, shouting about the confirmed tariff impact coming in Q4, a weak housing market, and those tough comps.
So that brings us to our call. We're rating the stock market perform. Here's our thinking. That direct warning about Q4 margin pressure is going to create an overhang on the stock for a little while. It'll likely keep it range-bound, but any significant weakness after that Q4 report could be a really compelling entry point for long-term investors. People who are willing to look past the tariff noise and bet on the power of their AI efficiencies and an eventual housing recovery.
And as always, a reminder, this is not financial advice.
And this whole situation leaves us with a fascinating bigger picture question.
Williams-Sonoma is proving that AI can deliver real compounding efficiencies. So at what point does that internal operational strength become so powerful that it can permanently outweigh the cyclical macro fears that have always plagued retailers? That right there is the key puzzle the market is trying to solve.